Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is January 4th, 2024, and we're going to discuss why tomorrow's non-farm payroll will matter. And normally we do expect non-farm payroll to have some significant impact and some directional move, but this one seems to have a little more weight to it than even before because we have this conflict between whether the Fed is going to raise rates or cut rates, leave them alone, or accelerate the loosening or the quantitative easing type of mentality, pushing more money back into the markets. But if non-farm payroll is doing better and improving, then are we seeing the reason why they are going to leave rates high, as their minutes said on Wednesday? But to start, let's go directly to the Bureau of Labor and Statistics website. And we're looking for just some consistency in the data. Notice, State Employment and Unemployment Survey. Unemployment rates were higher in November in 12 states and stable in 38. Okay, so that means we have more unemployment. That is definitely a sign of some weakness. And yet, the national unemployment rate edged down. So we have 12 states that are showing higher unemployment, 38 that are stable, and yet we're showing that our unemployment rate dropped. So I want to remind you that when we're talking about unemployment data is how many people are collecting unemployment, not how many people are lacking jobs. It's a little bit different data, and we'll look at that here in just a minute. But additionally, looking at more specifically the metropolitan area, the area that we have more employment. Yes, we only have 12 out of 50 states showing higher unemployment data, which we can extrapolate, say 26% are showing higher unemployment data, while the remaining 74% are showing consistency. Fine. But look at the metropolitan area, the area that we have more people employed. This is where the majority of jobs are in the metropolitan areas. And notice we have 214 of the 389 metropolitan areas that we measure showing higher unemployment rates. And so this is just in November than the previous November a year earlier. So if we're talking 214 out of 389, the primary areas where we have more jobs, then 55% of the major job centers, 55% are seeing higher unemployment rates. And you can see lower in 158 and unchanged in 17, but 55% are seeing higher unemployment rates. And that's a problem. That's a concern. We can go into the data, digging into the data a little bit deeper. You can go into the BLS.gov data and look specifically at the employment information. And we're going to scroll down to the employment information and going into labor force statistics. Top picks for labor force statistics. This is BLS.gov. And I'm going to look at a couple of different things really quickly, and then we're going to find some trades based off this. We have civilian labor force level. This is just the total number of people in the civilian labor force. Then it's going to show us the participation rate. How many or what percentage of that labor force are participating, trying to be in the workforce. So we're trying to work versus just the total number of people that are in the right age group and can work. Now we're going to scroll down and we're going to look at, we want employment level, sorry, before I leave here, employment level. And we want to look at unemployment level. And we can look at unemployment rate. So the employment level shows how many people have jobs. The unemployment level shows how many people are receiving benefits. That means they're still getting paid. They're still able to be a spender or a consumer in the economy, which is a good thing for the economy to have that money keep flowing. But we want to see how many people are actually employed. Now we're going to scroll way down here, and I want to look at the number of people that are marginally attached, the number of people not in the workforce, the number of people that are discouraged, that would have liked to have a job, but they don't think they can find a job. And then the last thing I want to look at is multiple job holders and multiple job holders as a percentage of total employed. Now that's a lot of data. We're going to go through this quickly because I want to get quicker into potential trade setups that we're going to be watching and discussing in tomorrow's main room. What we're looking at is to see if tomorrow the non-farm payroll will be reporting December, finishing out the year, Are we going to see the labor force go up or down? Are we going to see the number of participation rate go up or down, and the total number of employed go up or down? So notice that we've seen, if we're looking at month to month, we're seeing an increase of number of people in the workforce since April. 688, 166,000, or 166 million, excuse me, 818, 951,000, 167,103, higher, 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 then a little bit lower, and then super high again. So are we going to see the participation rate go up? And if we look at the participation rate, we had 62.8, 62.8, 62.7, a small dip on that same one. We saw the total number of people in the workforce dip, then 62.8. So we're holding pretty consistent that of all the people that can work, 62.8% are working. Now, if I scroll down a little bit further, as far as the employment level, the number of people with jobs, this is not the number of people that are employed just because we want to say so. This is the total number of people with jobs versus unemployment, which just tells us who's on benefits. So as we look at this, we have 0721, so 160,721, higher, 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 and then right through here, we dropped, and then right back up November to this highest level that we've been at. And you can see this 161,969. That is the highest number of employed, if we're going back through here, since 2013, at least back through this chart. And we'd have to go back to see previous data to see that this is the highest level that we've had in over a decade. And so if tomorrow comes in higher, that we see the total number of employed even higher, then what justification does the Fed have in cutting rates? If it falls suddenly, maybe we have a different story. So you see, we're starting to get a conflicting story. We have 55% of the metropolitan area showing higher unemployment rates, and yet we have the highest level of employment in over a decade, meaning the total number of people with jobs. And that means the total number of people spending in the economy. Now, as we scroll down the unemployment level, the people that are receiving benefits, you can see that went down, well, down, down, up, down, down, and are we going to see it go down again? So the total number of unemployment level, people receiving benefits, is declining, but that does not necessarily mean that we're seeing less people unemployed. What we're looking for is the people that are not in the workforce, and we can see those numbers as well dropped, spiked higher, and then started sliding again. Is that going to drop? These are people that want a job but are marginally attached. That number is going up. And the people that are wishing they could find a job, that they're discouraged and have kind of given up trying, so they won't be counted in the unemployment data, you can see this number has been going up as well. So the people that can't find a job and have given up trying to find a job, so therefore don't qualify as far as unemployment. They won't show in the unemployment number, but they will definitely show in the decline in the employed number. That is on the rise. Now, multiple job holders. This is also something that I pay attention to, because if inflation is still high, then more people are going to have multiple jobs just so they can meet their budget requirements, right? 7707, 7.7 million people have second jobs, 7.76, 7.9, 8.1 million, 8.0, little drop there, 8.151, 8.3, 8.3. So we've seen more and more people are holding multiple jobs, and just like the total number of people employed, this is the highest, well, last month, but last month was the highest number of people with multiple jobs in a decade. We actually had one little blip here in 2019, but it's the highest levels that we've seen in a decade. So that means as the numbers go up as percentage of people employed, we're seeing that more and more people have to have multiple jobs just to make ends meet. That tells us inflation is still high, that we feel like we need to be creating more income of the people that are employed just to be able to live. So we're getting a really conflicting story here. We have higher rates of unemployment, 55% of the metropolitan area, yet we have the highest number of people employed, yet we have the highest numbers of people with multiple jobs, which means inflation. So what do? This is really going to be highly impactful to us as we go into the end of the year, and really next month when we see other jobs disappear because they were seasonal, we're going to see likely another spike. We're going to likely see another move up in unemployment rates in February's report, which will be for January. But if we know that we're on this cusp, it's very unlikely that if we see higher employment data, that we will see those 2 rate cuts by May and 3 by the end of the year. If the jobs are still outperforming and we see continued growth, those rate cuts are not going to happen, and it's going to match what the Fed said in their minutes. What will that impact? And if they do see higher unemployment, if we do see jobs fall off, even though ADP and non-farm payroll from ADP today showed that that was not the case, if we do see that fall, then we're now looking at an idea that maybe we're going to see a higher likelihood of that rate hike. So let's go take a look at the 10-year Treasury yield, and then let's talk about consumer discretionary and Tesla. Let's talk about home builders, and let's talk about consumer staples, and we'll go into more detail in tomorrow's live session. And we're going to look at the TNX for the 10-year Treasury yield. We know that 10-year Treasury yield and the 7-year bond yield are kind of what home builders and mortgages are based off of. So 7 and 10 year are close enough that we can say, look, we're at 3.997. We'll just call it 4%. If we're at 4%, you're going to be getting mortgages between 6 and 6.5%. Add 200 to 250 basis points to that number, and that's what mortgages are going for. So if we're looking at that 4, therefore we're looking at 6.5%. But we were all the way up here, so earlier we were at 7.5%. So this is a nice drop, but you'll see that we bounced up. We had this decline. This was pricing in those rate cuts. Well, as of last week, we gapped up, traded outside of this channel, gapped up, retested the old channel, created a widening candle. And so if we get through this high, the 10-year Treasury yield seems to be pricing in a rally in yields, a drop in bond prices. And if we're seeing a rally in yields, that should curtail spending. That should slow the housing market. That should slow what we're going to see going forward with consumer spending and with the home builders. So we're watching this, and we'll talk about the timing of it in tomorrow's session, but we're going to watch for this to get above 4.01 and see if that's going to be enough to get us back up to 4.3, maybe up to 4.4%. If we trade above 4.4%, this is our yearly monkey bar, and therefore fair price would be all the way up at 4.82. That move would be almost a full percent higher in yields, and therefore we would be pushing back to about 7.8% mortgage rates. That would really hurt the housing sector. Now, if we're looking at home builders had a lovely bounce, and we saw that bounce after the sell-off, but the correction we saw in the home builders from the high to today's low was about 5.5%. Individual home builders have seen a bigger correction. This little bounce today, is it enough to see us go higher? No, it's a gap down, filled the gap, but if it ends up down for the day, below this gap, I'd say it's just a retest and filling the gap, and we could have some downside. We have to get close above here to be treated as an exhaustion gap, and I would say it has to trade above the high of this candle before we see anything move higher. And I would be looking at the individual companies in there and saying, let's take a look at those that are best poised to reverse. And I'd say Pulte has had a bigger bounce through here. You could look at DR Horton. DR Horton hasn't filled that gap the same way, and I'd say that has a potential rollover factor. We might look at Lennar. Lennar is an interesting one, but this also looks like we haven't filled the gap back through here either, and it might be one that we could be rolling over as well. KBH, KB Homes, again, hasn't filled the gap and could be a rollover as well. But we'll just look to see the timing in tomorrow's session. But the ones I'm most interested in are consumer staples and consumer discretionary. We take a look at consumer discretionary. Consumer discretionary has been in a major sell-off, and if we're going to see higher rates, this will likely continue. We see the same gap down attempt to close higher, filled the gap, but is closing below yesterday's close. We've already declined that same 5.5%, almost identical to home builders. This is driven by interest rates and yields and rate cuts from the Fed are driven by jobs, which is why we're paying attention to jobs so carefully. And XLY is through the low, and we know that this is highly weighted into Tesla, and we'll get to Tesla here in a second. But before we do, let's go take a look at consumer staples. If we're looking at consumer staples has already rallied, has already pulled back a little bit, but not anywhere near what we saw the pullback in consumer discretionary. As we're watching this move, this has filled the gap, but it's already in an uptrend, and the pullback is minor. In fact, we made a higher close. This is slightly lower close, but we're poised to make a higher close, and I think that consumer staples has the potential to continue to move up quite a bit. If we were to look at the companies within consumer staples, we would look at Walmart's, Costco's, Target's, Dollar General, Dollar Tree, Walgreens. Those are all things that we could look at in consumer staples. But before we get to consumer staples, let's go take a look at Tesla. Just do Tesla really quick. Tesla is at support, an old downtrending resistance being treated as support, a rising support being treated as support, and the oversold area of our yearly monkey bar. So what this does is Tesla's poised to either go up from here, from 240 all the way back, in my reading, of all the way back to probably about 275. So we're looking for about a 10 to 15% move up. But this little inside day is a harami, and this could be a bearish harami, it could be a bullish harami, because it's at this key inflection point, which means if we trade below yesterday's low, if we have a bearish close tomorrow, we could be looking at 200, and we're talking about a move from 240 to 200, and we're talking about a 40-point drop. That's going to be closer to that 15 to 20% decline in Tesla. And one of the things to be paying attention to is BYD outpaced Tesla in sales and is now selling more electric cars than Tesla is. So higher highs, higher lows, higher highs after this major drop down. We've already cleared this previous resistance, and this one looks more promising to me for a bullish entry based off of the fact that they just outpaced Tesla in total sales. And we still have some upside potential. Better bounce through here, and we could be looking at the trend continuing up to about 68. And that's also about a 10 to 15% move higher. The last thing we're going to look at in association with consumer staples are Costco and Walmart. So Costco and Walmart being two of the juggernauts inside that consumer staples area, you can see that Costco gapped down, closing inside this. So I'd say this is an exhaustion gap, which means we're probably pushing back to retest the 670. Not as big of a potential move as we saw in Tesla and some of the others that we might look at, but strong uptrend likely to continue. If we look at Walmart, Walmart has had a great little trend going on, but we pulled back the last day or so. But we started out the year super strong. So while everything else was selling off to start the year, Walmart had a very positive day. And as we're looking at this move up, this pullback, even though it gapped up, closed down, just retested that was an exhaustion gap up, but we don't have the same exhaustion gap here. We're just kind of pulling back. And as long as we don't clear 157, I'll be looking at buyout orders through here to continue this widening pattern into an uptrend. Walmart, Costco, we could look at Procter & Gamble tomorrow as well. We'll also look at Tesla and look for some setups based off the reaction and response to non-farm payroll. That's going to do it for me today. Have a great day. We'll look forward to seeing you in the main room tomorrow and talk to you again next week.